Think Realty Nation, it's Abhi Golhar. Welcome to the Think Realty podcast. I'm excited to be here today. We have an awesome show lined up for you. Number one, we're talking to Nathan from DLP, Direct Lending Partners, and then we're going to talk a little bit about some of the basic rules you need to know if you're investing in land. You know, I've done a couple of land deals. I don't consider myself a crazy expert when it comes to land deals, but there's an article, there was a blog post on thinkrealty.com that had a couple of good pointers, and we're going to talk about those. So the sponsor of today's podcast, we cannot do this podcast without our sponsor, so I want a huge shout out to my friends over at Narada Real Estate Investments. Thank you so much, guys. Narada Real Estate Investments, your premier source for cash flow investment property. Visit www.turnkeyrealestateinvestments.com. All right. So the conversation with Nathan from DLP is going to be a really cool one. I'm excited for this because for you new real estate investors and you pro real estate investors, you're always looking for the right kind of capital, but you're also looking for a relationship with the money, a relationship that's going to help you grow. And that's why Nathan decided to donate a little bit of his time with us today to kind of go through who DLP is, what does Nathan do there, and how can DLP kind of help us as real estate investors grow the portfolio, right? Like, we love the flips, we love the rentals. How do we do more of these deals? And so I have a couple questions for Nathan on what DLP does to make this happen. Nathan, welcome to the show. How are you doing, man?
Thank you, Abhi. Appreciate it. You guys are kind hosts here to have me.
You got it. I like that earpiece. I need one of these earpieces. Like, that just looks fantastic. I'm jealous. I love it, man.
As I say, there's a lot of real estate deals have been done on this headset here.
That's such a baller thing to say. All right, give us a little rundown. Who are you? What do you do? And who is DLP?
Sure, yeah, absolutely. So, Nathan Trunfio, president of DLP, Direct Lending Partners. I've personally been in real estate or lending for my entire career, really ever since getting out of college. DLP, Direct Lending Partners, we're a private lender, hard money lender, soft money lender. Wall Street calls it RTL space, residential transition loans. But what we do is we lend all discretionary capital to predominantly experienced real estate investors. Our main product suite is the fix and flip is our bread and butter. We also finance single-family new construction, and we do a ton of multifamily bridge loans as well. So we deploy all of our money from our own bank accounts that we raise from high net worth and ultra high net worth individuals, which really allows us to put a real relationship into our clients or with our clients so that we can help them grow and help customize solutions from a common sense perspective that you don't necessarily get when working with institutional banks that are run by bankers. We're more of a lender run by actual operators. So that's just who we are, Direct Lending Partners, and part of a family of companies here, DLP Real Estate Capital.
Awesome. You said two words which I think are really important. You said common sense. Are we losing sight of common sense in the real estate world today? Is that what you're finding? Are you kind of alluding to something here? What do I need to know, Nathan?
So, yeah, I would say a little bit. Okay. Look, when we running a lending institution, there's rules to abide by, guidelines to follow, and best practices to mitigate risk. But it's important to understand, what the end client, which is real estate investors, need and go through in order to reposition assets, build new construction, or take down multifamily properties. And so one reason why we think we can really deliver on a common sense basis is because we as a parent company do all of that. So just to give a little plug a little bit to all our other companies is we're the number one realty brokerage team in Pennsylvania in transaction volume, number 9 in the Wall Street Journal. So we see a lot of deals. We've been doing that. We've had the brokerage for over 10 years. We raise all our own money, so we know what it feels like working with investors and raising capital. And then more importantly, with all that capital, not only do we deploy it in loans, but we acquire a lot of assets as well. We started first fix and flipping. Our executives, including myself, we flipped over about 1,000 homes. But then we moved to these sort of economies of scale to multifamily. We now own 10,000 doors, predominantly all B and C class assets in the southeast. We self-manage 70% of the doors, so we have very large property management. We do all of our own construction management in-house. So we manage $25 to $30 million plus in CapEx projects. So we like to think we know what we're doing and can sort of lend with an operator's mindset and glasses just because, again, we are operators at the end of the day.
So obviously for me, if I'm looking at a lender and if I'm looking at creating a relationship with a lender, that starts with the investor, the borrower, looking at themselves first and saying, okay, history, collateral. We got the couple C's, right? Collateral, you've got the condition of the property, you have the credit, you have all sorts of things that lenders look at. And especially in the fix and flip space, I feel like we have to be, as lenders, we have to be more, we have to be a little more careful these days with the types of deals that are being done. What are some trends that you're seeing in the fix and flip space where you're lending out and investing currently that you can kind of shed some light on that could either be like a red flag, maybe a yellow flag, or like a green flag?
Sure. Yeah, absolutely. I mean, the nationwide stats show fix and flips have just digressed, and there's been a lot less of them over the last 10, 15 years. Even was reading even last night, CoreLogic put out some stats that nowadays 41% of all flips are done by corporate investors. So a lot more serious level of investors are really in the game compared to back in '05. I think it was about 11%. So we've seen a lot of experienced investors really gaining a lot of traction. And sure, there is a shortage of deals out there, but experienced guys are not running into that. And that's what we see. We will lend to inexperienced and experienced. But at the end of the day, realistically, it's very cliche. It's talked about way too often, but you make your money on the buy, right? So we've seen a lot of deals come through that are market rate deals. And it's just hard to really create value in those assets and make a good return on it. But experienced real estate investors, they've been doing this for a while. They've gotten really, really good at direct-to-seller lead generation. They invest a lot of money into it. They have full-fledged sales teams going out there, door knocking, driving for dollars, using different data aggregators to send mailers out, and doing a lot of hard work to get in front of good deals, because at the end of the day, you have to be really disciplined on the acquisition. So breaking down that, like you make your money on the buy, you're not doing it when you're selling the property. Sure, realtors are great, and they can, a good realtor can get you a little bit of premium, but that's not where you're really making money. And it's a misconception that the value creation or the renovation that you do on a project is also going to drive a lot of value. At the end of the day, it's back to buying at a good basis. And ideally, if you can generate the right type of opportunities and direct-to-seller leads, you can buy at a discount. So one thing that we use as a rule of thumb when doing an intake of deals, and sort of like I call a smell test, call it the 2x multiple on value add when it comes to your renovation. So what I mean by that is that whatever your renovation budget is on a fix and flip, typically you can expect to get double that investment in your renovations above the original purchase price. So I'll break that down with numbers in an example. If you buy a $100,000 property, you're going to put $50,000 in renovations. You're going to pretty much do, a full makeover of the property. The pencil math shows you should really get an ARV somewhere around that $200,000 mark. We see a lot of deals come in, and unfortunately, it's more so with newer investors. They have a $100,000 purchase and a $50,000 budget, and they think the property is going to be worth $400,000.
Right.
How are you really? Yeah. How do you create that much value, especially when the $400,000 market's a lot different than the $100,000 that you bought at? So sure, you can create that much value if you're buying a property at like $250 or $300. That's going to make sense. Or you're buying it at $100 and it's worth that much. So you're making your money on the buy. Understand that high level, 2x on your renovation investment. And then the other thing that we've seen is it's a crazy stat. I read this a long time ago, so don't quote me on this, but it's over 50% of new investors that try to flip their first property never flip a property again. So we know that, the lesser experienced investors they're out there, they're very active, they do some great deals, but that first deal is really most important. And when it comes to any real estate investment, you never cut corners on your due diligence, whether that's looking at the budget on renovations, on the acquisition of the as-is, the valuation when you're flipping it out on the ARV or as complete value. You have to be diligent and you have to be disciplined in making decisions, especially nowadays when it's important to play the numbers game, see a lot of properties, generate a lot of leads, and so that you can find the right deals to make the money on the buy, create some value, and hope for the best.
So when you talk about the 2x multiple, right? That's the 2x multiple on the renovation number. Is that also true? Is that also true then on in a market that is not as good as the market that we're in right now?
Sure. So great question. And, I guess I should go back and disclose that's a rule of thumb, right? So it varies per MSA, per region, and so on and so forth. But realistically, is it really worth an investment if you're not able to get that kind of multiple on your renovation? So, sure, with home prices being at an all-time high and inventory being a lot lower right now, you can definitely argue that 2x might be hard to hit. But at the same time, if you're not generating that kind of return, is it really going to be worth it? So we do a ton of multifamily deals, and it's one thing that we also do a smell test on. It's a little bit more detailed calculation, but what's your return on your CapEx budget? So if you're going to come in here, and take, especially when it comes to stabilized assets, and you're going to do a large renovation, does it even make sense to do that large renovation and go through the risk of repositioning the property, repositioning the tenant base, and so on and so forth? So, again, you can argue that it might be harder to hit that multiple, but diligent investors really need to stay disciplined to making sure that they're generating the right returns so that they can drive into good profits and continue to scale their business. So
the one word that you've been saying pretty consistently kind of over and over and over again is this word called disciplined. And especially now, right? Like, it's really funny to me how many people show up on a Super Tuesday in Fulton County in Georgia and start bidding on stuff that they have done zero due diligence on, and then they wonder, well, geez, why is this biting me in the butt? Well, come on, genius, right? Like, you don't have to go to the Mac store to figure out this stuff, right? Like, come on, do your homework and get this done. From the new construction side, however, that seems to be kind of interesting. Obviously, I should be looking at a better rule of thumb than the 2x multiple if I'm doing new construction, right?
Yeah, absolutely. And honestly, the new construction sort of product for us has been huge just because, our bread and butter has always been fix and flip.
Yeah.
And as we said, with market conditions, it's harder to find the right kind of inventory and, make money on the buy. So we see a lot of our investors have transitioned into that new construction realm. One thing that we do on the lending side, to help, a lot of times people don't understand when lenders put in these like leverage restrictions, especially on the ARV. So, people will sometimes ask, can we go up to 80% ARV? Well, sure, we can do that. But realistically, you see it all over a bunch of, podcasts and publications in the investing space, the 70% rule.
Yeah.
So that absolutely is the case to make sure that there is a profit there in the deal. On new construction, we actually typically limit it a little bit lesser than we do on the fix and flip side because you are putting a lot more blood, sweat, and tears into it most of the time. Sometimes it can take a little bit more to get through those deals. But at the end of the day, it's still making sure that you do have a good return on the monies invested. We've seen, again, some great trends on new construction. There's a lot of reasons for it, really because you can get a more predictable product. It's sort of like the analogy of if you're going to buy a new car versus a used car, which one's more likely to break down? As you go through the new construction project, it's a lot less unforeseen if you're experienced doing it. I will heed caution to fix and flippers that think that they can just go out and find a good contractor and build a home. You really got to do your due diligence on that. And then another great thing is that, people in the fix and flip space are having a hard time growing and using economies of scales because the inventory doesn't allow them to buy a lot of product that's close together. But there's a huge and plethora amount of infill lots from, really the crash and they've been sitting around that got developed but never built upon.
Yeah.
And you can look to grab those up in little bunches. So we have a lot of investors that are doing 2, 4, or 6 starts at one given time. It really drives economies of scale. You can drive down your material costs, your labor costs, because you pour the foundation in one day, second the next day, and so on and so forth. You bring in the mechanicals at the same time. You frame it up at the same time. You buy more material in bulk. And so, at the end of the day, back to your original question, you have to make sure that there's a good value creation when you're building, because you certainly don't want to be going through all that work to not have a good return, whether you're going to build to sell or the big hot topic out there of build to rent.
Man, yeah, I wish we had time to talk about build to rent. That is a very, very, very interesting topic. especially for those that are more vertically integrated and they can absorb these costs, and they can, like you guys, right? Like DLP can do this.
Yep.
Man, we should. So the next topic list that I have from you is going to be build to rent, right? Like we're going to have you back and we'll have to talk about specifically build to rent. But I have two questions for you. Take maybe 15 or 20 seconds per question. DLP has lending programs, especially for the fix and flippers and the new construction and then your single family rentals. Walk me through those. Walk me through each of those programs. What does a new borrower have to do to qualify? Give me about 30 seconds.
Yeah, absolutely. So on the fix and flip side, we'll lend up to 90% loan to cost. Okay. That's for experienced operators. We can't lend to people that don't have as much documented experience, but we're usually giving a little bit of haircut in what we can do from a leverage standpoint. On the new construction side, we fund the easiest way is 100% vertical financing. So you bring the dirt, shovel-ready infill lots. We'll finance from foundation up. We typically don't finance the development work, the horizontals, and things like that. I'm actually rolling out. We control all of the deployment of our capital, but yet the rental product is something I'm rolling out in Q4, and really that's because we have to go to sort of Wall Street to find a place for that. Yeah. We don't want to be holding paper because we got to write it very aggressive. So that will be coming out in Q4. And then on the multifamily side, we finance typically up to about 80% loan to cost. That's inclusive of purchase and any CapEx budgets. So that's the very high level on all that. But like I said, we like to think we use a lot of common sense and provide a lot of value to our clients and really help them scale. 1,000%. And I'm on your website right now, www.directlendingpartners.com. So for anybody listening, watching, if you want to get more information, definitely go to directlendingpartners.com. Nathan, what's the other website, if you have one, or is that the best one for you? Sure. So our parent company is dlprealestatecapital.com, but directlendingpartners.com for all of you that are looking for a good funding partner. That's where you want to go to find out more and get in touch with us. Awesome. Two more questions for you. Number one, you have a crystal ball and I still have a snow globe, and I'm trying to figure out like how to make this thing a crystal ball. Where's the market? Where do you think the market? I know it's a very pregnant question, right? It's like there's no real like national real estate market. What's your overall gut feel where the heck we're going to be in a year? How about that? that's a better question. Yeah, so a lot of people are scared of the big B word, the big bubble. It's that. So I honestly think, and what we think from a lot of the research, and we like to think we have our ear to the ground because we see a lot of deals as an operator and obviously as a lender. I really don't think there's going to be too much change. But what I will say is that I really think that experienced operators are going to continue to thrive in these environments because they're the ones that are typically staying the most disciplined. And then a lot of people that watch an HGTV special, whether they get hurt in going through some of these projects or not, we certainly hope not. But it could be a little bit harder to continue to create value in a lot of these opportunities. But I don't think the market's going to change too much in a year. I don't think there's anything to be worried about whether you have experience or not, especially if you have a good partner and good mentors to help you along the way to be disciplined and diligent. Nathan from DLP, thank you so much for joining me, man. I appreciate the time. Go to www.directlendingpartners.com. And Nathan, the other site one more time was? DLPrealestatecapital.com. DLPrealestatecapital.com. Nathan, thank you so much. I appreciate it, man. Thank you, Abhi. Appreciate it. Hey, you got it. Think Realty Nation. This next segment is brought to you by Real Property Management, which is the largest residential property management franchise in North America, managing tens of thousands of properties for individuals, investors, and institutions throughout the country. Learn more at realpropertymgt.com or call 888-806-7088. Ladies and gentlemen, boys and girls, the captain has illuminated the fasten seatbelt sign. Let's talk about lending. Let's talk about land, not lending in land, investing in land. That's really what I meant to say. We just finished talking about lending, which is super hypercritical. DirectLendingPartners.com. Let's talk about land for a second. When you're purchasing lots, right, like we're always looking for that next deal. We always want that in. But when you're purchasing lots, there are a couple of things that you need to know. Number one, obviously, real estate is a location game, right? I'm a broken record for that reason. It's a freaking location game. Get the location right. Number two, zoning. Number three, lot size requirements. Number four, access. Can the lot be accessed from both the front and the rear of the lot? And number five, restrictions. What kind of restricted use covenants are there?
in place for this land, right? So massive issues there. Potential issues. Permits. Are there any special kind of permits that you need? Utilities, budget, easements, function. As a new construction play, infill lots are a very, very unique item. And if it's in an area where you can show a history of good inventory being sold, someone like Nathan would look at that and say, hey, you know what? We have a good history here. You've done some good deals. Here's an opportunity that makes sense. And a new construction lender like DLP will recognize the opportunity and partner with you to get that deal done. You just need to make sure that you qualify on your end and build a really, really strong team to make sure that they have the confidence to lend to you. So really absolutely make that possible. But, you know, investing in land, I've been reading a lot of articles, whether it's tax liens, lands, probate, about ways that investors now, those tried and true, like pro investors, what they're doing to find the right inventory. And let me tell you, I'm loving this land idea. I'm loving the B2R stuff that Nathan and I will talk about on a future show. But also the tax lien piece, I think that is so, so crucial. A little while ago, we had Greg Slaughter on, and we talked about how you can buy a tax lien, and then you can quiet the title, you foreclose on it, and there you go. Now you have an asset that you purchased for pennies that's worth like $150, $160, maybe $125,000, right? So there's some crazy opportunity there as well. That being said, take a look at land. Get in touch with my friend Nathan at DLP. Again, www.directlendingpartners.com. And Think Realty Nation, you need to know that this podcast was brought to you by the none other, my good friend Marco Santorelli over at Narada Real Estate Investments. Check him out. Your premier source for cash flow investment property. That's Narada Real Estate Investments. If you want to visit their website, go to www.turnkeyrealestateinvestments.com. Think Realty Nation, it's been a fun one. Until next time, happy investing.